According to the central bank, 7 of the largest banks in the country tightly hold 80% of the market, while 35 share the remaining 20%. This comes as the market undergoes mergers and acquisitions, with the government also looking to consolidate 3 of state-owned banks. And beginning today, some of them, including 12 microfinance institutions, might be forced to line up at the central bank to access the financing facility in what the regulator says will help them tame the bank run that has brought about liquidity crunch.
We will avail a facility to any bank or microfinance institution that comes under liquidity pressures arising from no fault of their own. We will avail this facility for as long as necessary to return stability and confidence to the Kenyan financial sector.
Last week, panic withdrawals depleted Chase Bank's deposits, prompting CBK to place it under receivership of the Kenya Depositors Insurance Corporation. The bank was also found to have violated the Banking Act 2015, which limits loans to below 25% of the core capital. When it emerged, it advanced loans amounting to 16.6 billion shillings to staff and directors as well as their private entities.
Mimi nataka kusema nakubaliana na governor tumempatia uhuru wa kuhakikisha ya kwamba wale ambao wanafikiria ya kwamba biashara ya benki ni biashara ya kunonesha mifuko yao wajue ya kwamba siku hizo zimeisha.
This pushed the bank's non-performing loans in 2015 to 11 billion shillings, up from 3 billion shillings a year earlier. In August last year, 2 months after CBK Governor Patrick Njoroge assumed office, Dubai Bank was also placed under receivership and is currently in liquidation. October 2015, Imperial Bank was also placed under receivership. Government-owned NBK has also undergone a financial turmoil, prompting suspension of CEO Munir Ahmed and 5 other directors. A warrant of arrest has been issued for the directors as well as Chase Bank former CEO Duncan Kabwe and Chairman Zofula Khan. A common factor for the 3 institutions, however, is what CBK terms unsafe and unsound business conditions, including depleted capital and liquidity ratios, which make them susceptible to risks. In January last year, introduction of capital buffers by CBK to allow banks to contain any risk required banks to have core and total capital ratios of 10.5% and 14.5% respectively, which every bank must maintain at all times.
All the banks are able to operate within a regulatory regime that has been put in place. Then that is really what we want, and be it small, be it big. But I think we need to get out of this perception that small banks are going to be hit because of this. Yes, there could be challenges in terms of increasing their capital ratio.
We are united as an industry to ensure that we resolve the challenges that we are facing currently. But the banking sector is strong and viable.
This is also meant to ensure banks absorb additional loan loss provision required in the event of an increase in non-performing loans. Now it remains to be seen whether the facility being provided by the central bank will contain the current run on banks and bring back the lost confidence among consumers. Ronald Owili, News Business.